Hello, everyone, and welcome to today's lecture. So, today we are going to continue the topic of audit of insurance companies. Okay. In last lecture, we discussed something about insurance companies, like the types of law that can be applicable to a particular insurance company, section with respect to the definitions of Indian insurance company, the respective other definitions which are covered, health, life, general, and each of them has then general is bifurcated under fire, marine, and miscellaneous. Then we discuss about what is an insurer means, uh, the type of bodies that are there for the insurer. So now today my prime focus will be majorly on, just first I will be covering the basics, discussing some areas, and then majorly on the practical side, the questions which have been asked, the questions which can be asked, a lot of questions I will be covering, rather than going in with respect to the theory side. I'll go more on the practical side and how it has been asked in the exam. Okay. However, at any point in time, if you guys feel, you need you have any doubt, please feel free to ask. Okay. So we discussed about the section 29 insurance means, who is an insurer. Now, the next area or the next thing that we need to understand is the requirement of registration, basically. Okay. And why? Reason because I'll just give you a glimpse that there is a requirement for the registration, like we have in MDSC. Okay. Same way we have a requirement of registration in here also. So section 3 of this particular act, that is the Insurance Act. Section 3 of the act says that, without a certificate of registration, no person shall carry on the business of insurance. So without registration, without certificate of registration, no person shall carry the business of insurance, means the above businesses that we discussed. Okay. Now, if the persons are not required to carry on the business without certificate of registration, means they need to apply for the registration. And if they need to apply for the registration, then what will happen is there are certain terms and conditions for the registration they need to comply with. Okay. So if a person who wants to carry on the business of insurance, and when I say person, that comes into the definition of insurer. So any insurer wants to carry on the business of insurance. If they want to carry on, then they need to comply with the requirements of registration. Okay. The requirements of registrations are, provided in various, what you can say, rules, regulations on a different level, different requirements with respect to the solvency of life insurance, solvency of general insurance. So there are various regulations which are prescribed in this area. So they have also provided the method of valuation for some assets and solvency. So a lot of things which are already a lot of things have been provided, but just to highlight, minimum paid up capital. Okay. So the minimum paid up capital to carry on the business, insurance business, is 100 crores, that too excluding preliminary expenses. Okay, that too excluding preliminary expenses. So the requirement for the minimum capital is 100 crores, excluding my preliminary expenses. So that is the requirement of uh, minimum paid up capital. Okay. Now, when I talk about these businesses, like, general insurance and life insurance, so when they go for application and for application of like a certificate of registration, in all the cases, they are required to submit. They are required to submit forms, details with respect to the valuation of assets. Okay, and there are detailed guidelines available in the regulations with respect to valuation of those assets. Okay, so just to give you an highlight, I'll show you. We will not be deep diving in these regulations, just to make you aware about the regulations that I'm talking about. So these are the IRDA asset liability solvency margin of general insurance business regulations. Okay. Now these regulations prescribe how to value the asset. Now this is applicable for general insurance business. Okay. Now, like when I was talking about preliminary expenses, so they say that the valuation of asset, the following assets should be placed zero. Now in that we have a deferred expenses. Okay, any debits of fictitious assets or prepaid expenses, something like that. So already they are placed to the zeros. So there are already a valuation guidelines which are there, which we are required to apply to calculate the minimum paid up capital, to calculate the solvency ratio, solvency margin, and all these things are then submitted to the registrar, yeah, authority. In this case, basically we call it authority. Now let's say, for example, I'll show you one of the requirements where where the entity or the particular insurer is required to submit the form IRDA GTTA, that is that provides the investment. Okay, it's applicable to the general insurer, and this form gives the total business total investments and the details about the investment of the insurer. Okay, see, investment, fixed assets, current assets. So it gives you the total investment in the assets and total investment in that the person is going to put into his business, like in total asset basically. Okay, and the thing is, not only the insurer is required to provide this detail, but the statutory auditor of the company is required to sign and audit this particular certify this particular form. Okay, now when you are going to certify this particular form, all the details in this form, again, you need to review it. You need to see whether they are correct or not, and need to accordingly plan that, okay, what audit procedures you are required to perform for all these items. Basically this is just a asset side of the balance sheet, so it will have the same, but again, also whatever certificates or whatever, wherever you will issue a signatory, you will be a signatory authority. At that point in time, you need to perform the audit procedures. You need to, before certifying any such thing, for example, this form IRDA GITR, that's total revenue. So here you provide the details of the total revenue, okay, plus reserves, total reserves. So again, here if you see, here is a certification from statutory auditor, which says that name and signature of the statutory auditor, and you provide a certification. So like this way, person is like statutory auditors are involved when it's a time of the registration, it's annual form submissions, annual compliance. So you become a part of this particular exercise and you need to verify all these things. Now here, let's say for example, this reserve one. So here, if you see the certification, what certification says that I certify that the above statement represents the liability of the insurer which have been determined in the manner prescribed in the Insurance Regulatory Development Authority Asset Liability Solvency Margin of General Insurance Business Regulations. An amount of such liabilities and fair are reasonable. I also further certify that the outstanding claim reserves that are estimated using statistical method, PDR and IBNR reserves in the statement above has been determined by appointed actuary, and this certificate is furnished below. So what I'm saying is the IBNR, okay, IBNR reserve and PNR reserves, PDR reserves, that is a premium deficiency reserve, they are calculated based on the appointed actuary's valuation. Plus, for the rest of the reserve, they are calculated as per the required provisions. Now, for that, it is necessary that I should be aware about the provisions that are, that are applicable in this case for the calculation of these reserves. Okay, let's say for example, these like if you see over here, actuarial valuation methods are given, which are allowed for the valuation. Then valuation of reserves. If you talk about valuation of reserves, valuation of reserve is given over here in this particular regulation, how the valuation of reserve should be done. And there are other clarifications and orders which are issued in this regard. Okay, but just to give you a glimpse that how it works. Okay, so this, in this way, same way we have regulations for regulations for life insurance companies. Okay, where life insurance companies for their solvency margin and their for annual compliance, they are also required to submit the details, and these details again we are part of it, we need to certify as an auditor. Okay, this is for the life insurance business. See, determination of solvency margin. Every insurer shall prepare a statement of the solvency margin in accordance with the Schedule 3 in respect of life insurance business. So they are required to submit the solvency margin as per the Schedule 3. If I go to the Schedule 3 over here, so this is for the life insurance business. Okay, now what they are saying is available solvency margin means the excess value of assets, okay, as furnished in form AA specified under insurance this particular actual report and extract of life insurance business regulations 2016 over the value of insurance liability. So excess of value of asset over the value of insurance liabilities, okay, and value of assets calculated as per the or furnished in form AA, okay, will be like your available solvency margin. So excess of value of assets over the value of insurance liabilities and other liabilities of policyholders funds and shareholders funds. Basically, you deduct the value of insurance liability and other liabilities to get the available solvency margin ratio. And if you talk about the solvency ratio means amount of available solvency margin to the amount of required solvency margin as specified in Form KT of the this particular regulations. Okay, so it again depends upon again it's a ratio that what is the available margin, what is the required margin. So that is the ratio, is the solvency ratio. So when I talk about available solvency margin, it is value of assets less your value of insurance liabilities, life insurance liabilities, less other liabilities pertaining to policyholders fund and shareholders fund. Okay, so you need to deduct these things from the value of asset to get the available solvency margin ratio, and available solvency margin divided by required solvency margin is your solvency ratio. Okay, these are certain formulas and the understanding of term, because we will be seeing these terms going forward when we'll be discussing about the areas how to audit each and every area. Okay, then so so it is like it's a requirement for the insurance business that every insurer at all time shall maintain its available solvency margin at the level which is not less than higher of 50% of the amount of minimum capital, okay, and 100% of required solvency margin falling like within that particular category. Okay, so what they are saying is your available solvency margin should be higher of 50% of minimum capital, okay, that is required as per section 6, or 100% of required solvency margin, higher of both. So available solvency margin should be higher of 50% of minimum capital or 100% of required solvency margin. That is the required amount, and that should be, if you see the wording, that should be every insurer at all the times. It's not something that at the year end, but at all the times it is required to be maintained by every insurer. Okay. Now, when I talk about minimum capital stated under section 6, okay. Now, section 6 of the Act, I'll explain you section 6 of the Act, and it's important to understand. Section 6 is a requirement of capital. Section 6 there says that no insurer, being an insurer, defined under this clause 2 of section clause 9 of section 2, can carry business of life insurance, general insurance, or health insurance, okay, unless he has the required capital. And the required capital for carrying on the business of the general insurance, okay, and the health insurance. So the minimum paid up capital that I was talking about is coming from section 6. So for the general insurance, health insurance, okay, or life insurance, the minimum paid up capital required is 100 crores that we discussed over here, the 100 crores minimum paid up capital. Okay. Now, there is like general insurance will cover marine, fire that we discussed. Remember in the start only, like my fire, marine, and miscellaneous will be covered by the general. There is one more type of insurance business, reinsurance. Now, what we mean by reinsurance? Reinsurance means, you know, a business where a person or an insurer insures the risk of another insurer. It's a reinsurance sort of. Okay. Now, in case of reinsurance, the paid up capital requirement is 200 crores. Okay. So the paid up capital requirements, it's 200 crores. Now, there is another requirement that is there in my section 6. So section 6 provides the requirement for the net own funds. So the requirement of the net own funds is 500 crores for these type of, for all the type of business. So that should be not less than 500 crores. That is the net own fund requirement. That section 6, subsection 2. Okay, which says that the about the net own funds. Now, if that particular business, okay, being a foreign company, or let's say for example my insurer is a foreign company, or is in engaged in reinsurance business, okay, either through IF and registered through IFSC, you know, and it's in the special economic zone, okay, then in that case the requirement changes, it becomes to 1,000 crore, but that is specific to only that. So if, okay, insurer being foreign company plus engaged in the reinsurance business, okay, engage in the reinsurance business, plus that business is carried through a branch, okay, which is established in IFSC, International Financial Service Center, okay, then in that case they are required to have net own funds greater than 1,000 crore. Okay, for them the requirement becomes 1,000 crore if these conditions are there. So that's one of the specific case. I'll just bring it a bit down. Okay, so that was the net own funds requirement, and where we were at the discussion, like, you know, we were discussing about the available solvency margin ratio. So now you know what is the minimum capital required as per section 6. So this is as per section 6. Now 50% of the minimum capital or 100% of required solvency margin. Out of the both, you need to have that will be your available solvency margin that you need to maintain. Okay. And what they are saying is there is an additional requirement, like again, so you know, there is a section 64 BA, okay, which talks about the minimum solvency ratio, which provides us the minimum solvency ratio. So as per section 64 VA, or you know, the rules there are made under the control level of solvency, that's the minimum solvency ratio, is at 150%. So the ratio that we are calculating over here, ASM by RSM, should be 150%. Clear? Any doubts till now? Any doubts? Yes, Shailendra. Minimum paid up capital 100 CR excluding preliminary expenses. Any doubt, guys? See, I'm just trying to provide you a perspective, some terms and terminologies I'm trying to explain you, so that when we'll go ahead, we'll discuss rest of the areas. It will be very easy for you to understand. Okay. Any doubts? Okay. So there is one question: how to calculate RSM? That's the required solvency margin. See, required solvency margin is required to be calculated as per Insurance Regulatory Development Authority of India actuarial report and abstract of life insurance business regulations. So that is calculated in form KT3. There is a format given there in form KT3, and accordingly we are required to calculate. So let me see if I can show you the form KT3. So there is a detailed calculation given. It's I'll just show you a glimpse of that because it's a very detailed calculation which is provided in that. So this is form KT3, okay, where it is calculated available solvency margin and solvency ratio calculation. Now, if you see how it is calculated, same like I told you, available solvency margin is a available asset to the policyholder funds. They deduct mathematical reserves, other liabilities. Then you get, excess in policyholder funds. Okay. Then they deduct other liabilities of shareholder fund. Okay. Then you get excess in shareholders fund. That is total ASM, total RSM, and then they calculate the solvency ratio. Now the total RSM here is as per a schedule, which is again part of this particular uh, provision only. Let me show you. So again, there is not single, what you can say, required solvency margin calculation. There are a lot of factors involved. I'll just show you. See, this is the required solvency margin calculation. Okay, required solvency margin based on mathematical reserve and sum at risk. Uh, it's something, I'll say it's a very detailed calculation which is there. A lot of, the detailed calculation is required for this particular one. So you calculate the mathematical reserves after reinsurance, you apply the factor, and then, there are factors given for each type of, what do you say, the policy. So required solvency margin factors are there for, first factor, second factor, you need to apply that, and then you need to calculate, after applying the factors for each type of policy term and, each type of asset, it's different. And then accordingly, you get this particular RSM. Okay, so that is one. So accordingly, you get the RSM, and this RSM is then is used here to get the solvency ratio. So this is how the solvency ratio is calculated. Any doubt till now? Same way it is there if you go for the general insurance also, determination of solvency ratio and available solvency margin ratio, it's same. If you see for general insurance, like excess of value of assets over the value of liability, okay, that is the available solvency margin, and solvency ratio is available solvency margin to the required solvency margin specified in table IV. And control again, so minimum solvency ratio 150%. Okay, and they have given the form here for the general insurance how to calculate. So see, this is a statement of solvency margin. Factors are again given for each type of business: marine, fire, motor, aviation, everything. So you calculate the solvency margin here, and then you calculate the solvency ratios. Okay, so this is how. And again, here this is required to be certified by the appointed actuary and the officer CFO of the company. Okay, so that was for the general insurance business. Now, that was some of the regulations with respect to your solvency margin, paid up capitals, and the solvency ratio, just to make you understand how it is calculated, how it is done. Now, I'll come back to our provisions. Okay. Now, we were talking. Now, these were the requirements where we are, as an auditor, we required to certify something. But over and above that, we are required to audit the insurance business, the financial statement of insurance business. Now, I have one question with you guys. Like, in company side, there is a provision which requires the audit. Okay, which requires the audit. Can anyone tell me which is a section or what is a provision in the Companies Act which requires a company to get its account audited? Which is that particular section in Companies Act? Which is that particular section which requires the company to get their accounts audited? Come on, guys, pretty easy. Which is that particular section which requires the company to get its accounts audited? Let's see. Pretty easy, guys. I think you have dealt with this particular provision multiple times. Nope, Shailendra. No, Kaushiki. What is the provision in Companies Act which requires us to get our accounts audited? A particular company. Come on, guys. So in Companies Act, if you go to a particular section, that is section 129, okay, if you see subsection 3, it talks about where a company has subsection 4, the provisions of this act applicable to the preparation, adoption and audit of financial statement of a holding company shall apply to a consolidated financial statement also. Plus, if you go to a particular section, section 134, that's the financial statement board reports. Over there, it is specifically said that the auditor's report shall be attached to each and every financial statement. So 129, 134 both covers the audit requirement. And when I talk about 143 or 143, that's the powers and duties of auditor. That gives the power to the auditor for the audit. But when I talk about 128, 129 and 134, these are the sections which provides, okay, these accounts are required to be audited. And why I am mentioning this particular section, reason because if you go to section 129 of the Companies Act, there is a provision that it says that if certain items are not required to be disclosed by an insurance company, okay, which are prescribed in the Insurance Act, then it shall not be treated as not disclosing a true and fair view. Okay, so usually the section requires that the financial statement should give a true and fair view. But if there are certain items which are not required to be disclosed by the Insurance Act for an insurance company, okay, then in that case it shall not be treated as a that particular financial statement is not disclosing as a true and fair view. Means Insurance Act or the regulations by IRDA are given more priority, have a more authority compared to the Companies Act when it comes to the disclosure of financial statement. Okay, so my section 129 follow says that first follow Insurance Act plus IRDA regulations. Okay, for which thing? For preparation and presentation of financial statement. Okay, so section 129 of the Companies Act 2013, okay, says that that follow Insurance Act and IRDA regulation first for the preparation and presentation of financial statement, and it says indirectly, not directly. Now, when it says to follow the preparation and preparation and presentation of financial statement, Insurance Act. In Insurance Act, if you go to section 11, okay, if you go to section 11 of the Insurance Act, it says that accounts and balance sheet required to be maintained. Okay, so that says that every insurer shall prepare balance sheet, profit and loss account. So it says that shall prepare balance sheet, profit and loss account. Okay, a separate account for receipts and payments, a revenue account, okay, a separate account for receipts and payment, a revenue account as per the regulation specified. Okay, so my Insurance Act says that please prepare balance sheet, profit and loss account, a separate account for receipt and payment, and a revenue account. It's not something the Companies Act is saying me to prepare these things. It's Insurance Act which is saying me, and that's why there is a difference when you come to the you know particular state. If you come to the regulations and financial statement of insurance companies, that's why it's different. Number two, it says that they are required to be prepared as per the regulations. Now, when they say this is required to be prepared as per the regulations, which are the regulations we are talking about over here? What are the regulations that will come into picture? So, there are the set of regulations. There is a regulation given. Insurance Regulatory Development Insurance Regulatory and Development Authority preparation of financial statement and auditor's report of insurance companies regulation 2000. Okay, so these are the regulations under which we are required to prepare as per we are required to prepare the financial statement, and the format is given plus with respect to the audit report. Now that was with respect to the financial statement, but where is the audit? So if you go to again another section, section 12, okay, of Insurance Act, that particular section says that the balance sheet, P&L, profit and loss account prepared as per the above. So the financial statement prepared as specified under section 11 or as above. Okay, in respect of all insurance business, or in respect of all insurance business are to be audited by an auditor okay, are to be audited by an auditor, and that auditor will have all the powers, duties, and all the liabilities, penalties imposed, everything will be same. It will have all the duties, okay, powers, functions, and subject to the liabilities and penalties that are there as per the Companies Act. So section 12 says me that preparation, the financial statement that has been prepared is required to be audited by an auditor as per section by an auditor that will be appointed here. Clear? So now you understand from where the audit requirement is coming. Audit requirement is coming from section 12, and preparation and presentation of financial statement and audit report are as per the regulation which are there, regulation 2000. That is a very important regulation that we are now going to discuss. Okay, now when I talk about this particular regulation, I think in intermediate you have already seen the financial statement of insurance companies. I'll quickly show you if I have one of the financial statement of a particular insurance company. Just give me. Just give me a minute. I think there is some error at my end. Just give me a minute. Let me check. Okay. I think some error is coming, but let me show you the account that I was talking about. See, so this is the revenue account that is prepared. So this is one of the listed company. Okay, this is how the revenue account is prepared. We have already seen. Okay, then it comes to the profit and loss account for that particular company. I'll show you. This is the profit and loss account that has been prepared. You can see, operating profit as per the revenue account from fire, marine, and miscellaneous insurance business. So they have bifurcated over here: fire, marine, miscellaneous. Okay. Then income from investment, other expenses, and the profit that is there. Post that, there is another account. Then we are required to prepare a balance sheet as per the regulations. So I'll show you the balance sheet. Okay. See, this is a balance sheet. This is the sources of fund, my capitals, application of fund, that investment in, investment of shareholders, investment of policy holders, and accordingly, then the net current liabilities, debit balance of profit and loss account, contingent for contingent liabilities. There is a separate schedule given. Okay. Then receipt payment account that is there. I'll show you the receipt payment account. See, this is the receipt payment account. These are all the receipt cash flows from the my receipt payments for the March and the 31st March 2022. These are all the receipt operating activities. This is again from investing activities. This is from the financing activities, net cash flow, and cash equivalent and everything. So receipt payment account is similar on the similar line of the cash flow statement. Okay, so you can say it's a similar line on the cash flow statement. Then there are the rest of the schedules which are specified here, like schedule for the premium, schedule for claims, commission, operating expense, then asset related schedules, reserves, surplus, liabilities, and everything. So all these schedules are there. So that is as per the what you can say, the required format. Okay, so that is as per the required format. Now, this required format is coming from that regulations that I was talking about. Okay, the regulations that is the regulations that we discussed, preparation and presentation of financial statement regulations 2000. The format is prescribed in that the schedules here that we have discussed, the format is coming from that particular regulation. Okay, now there are some additional informations also given in that regulations that we need to discuss. Okay, so those additional information, I'll come here. Now we need to understand these additional information and additional requirement which are given in this particular regulations, and that helps us to understand the preparation and the presentation of the financial statement. Okay, so I'll start first of all. Applicability of the accounting standards. Okay, applicability of the accounting standards. Now, if you see, these regulations specifically says that, okay, the accounting standards, shall be applicable, which are issued by ICI to the extent they are, in alignment, except two. So all accounting standards are applicable. I'm talking about accounting standards, not the NDS. So there is a difference. Okay. So I'm talking about accounting standards which are applicable. So all the accounting standards are applicable to the insurance company. Okay. To the insurance company, except for two. Now these except two are, I'll show you. First, my AS3, which is cash flow statement. Because they are prepared under the direct method instead of indirect method. They are being prepared under the direct method. If you see the receipt payment account, it shows the direct method. Okay. And AS17, segment reporting. Why segment reporting? Because why segment reporting? Reason, because segment reporting, there is a different requirement also for the segment reporting. So cash flow is required to be prepared as per the direct method. Okay, only under direct method. And segment reporting. Now, in case of segment reporting, there is a specific requirement that it is applicable to all insurers, irrespective of listing or turnover requirements. Okay, mentioned therein. So if you see segment reporting, it is not applicable to some of the entities as per the accounting standards applicability, but here it is specifically said that it will be applicable to all insurers. It will be applicable to all insurers, irrespective of listing or turnover requirement. In case of AS3, cash flow statement is only required to be prepared as per the direct method. So that's why there is a you can say change in these accounting standards applicability for insurance company. Other than that, these financial statement like balance sheet, revenue account, receipt payment account, profit and loss account shall be in conformity with the accounting standard issued by ICI. Okay, means all accounting standards are applicable to an insurance company. Clear? Any doubt? Okay. Now, coming to the next area is with respect to the premiums. So it says that premium shall be recognized as and when it is due. Okay. Premium, it shall be recognized as and when it is due. Okay, so premium is required to be recognized as and when it is due. Then comes the acquisition cost. In case of acquisition cost shall be expensed in the period in which they are incurred. Okay. they relate to, acquisition costs are those costs which are, required to be incurred for the new and renewal for the, obtaining new and or renewal of insurance contract. So acquisition cost is not something, acquisition of the company, it's but the acquisition of the customer or insurance contract basically. Okay. So they are required to be expensed in the period in which they are incurred. Okay. Now, actuarial valuation, liability for the life policy. So in case of life policies, actuarial valuation is required. Again, that requirement comes from the section 13. Okay, but with respect to actuarial valuation, the estimation of the liability, again, the life insurance policy is required to be determined by the actuarial valuation, okay, by the appointed actuary. Now, in this case, what happens is the valuation that is provided by the actuary, okay, is we are required to adopt that valuation. So, but having said that, the actuarial assumptions that the valuer takes or actuary takes, we are required to disclose, or the management is required to disclose by way of notes to the account. So assumptions, actuarial assumptions are required to be disclosed, okay, by way of notes. And if I show you example like how they are disclosed, so actuarial valuation, actuarial assumptions, are disclosed in detail with respect to the method followed. You can say, what are the factors they are considered for the valuation, and that is as per the report. You can say, all these assumptions are already there in the actuarial report. But again, let me show you. See over here. This is one of the notes to account. This talks about the actuarial methodology. Okay, how the actuarial methodology, which methodology has been appointed over here. Okay, so see, the chain ladder method has been applied for motor, fire, marine cargo, engineering package, rural extended warranty, etc. And all these government scheme, travel, motor, and miscellaneous line of business. So they are talking about chain ladder method. Okay. Now, if you go to the provisions, with respect to the actuarial valuation, now I'll show you with respect to the general business. Now, these were the regulations with respect to the general business. Okay. Now, here, if you see actuarial methods which are available, basic chain ladder method, Braun-Hutter-Ferguson method, and frequency method. So these are the three methods which are there, and this is for the both incurred and paid claims. So this method has been used. If you see in this here note, in this particular note, they will say that okay, chain ladder method has been used from the given method. Okay, so it talks about the method which has been used for the actuarial valuation. Also, it provides a detail with respect to with respect to the your reserves, and how it has calculated and for which business it has calculated. Okay, so the detail has been given in a way of a note. Also, there are additional disclosures with respect to the actuarial valuations and valuations of life insurance business. But this is not the case of life insurance business. This is the other what you can say other insurance categories. That's why it's a a lesser disclosure compared to the life insurance business. Okay, so that was the actuarial valuation of life insurance business. Now there is a procedure to determine the valuation value of investments. Now valuation of investment, you can say. So valuation of investment, there are certain guidelines given in these regulations only, which talks about how to value the investment. Okay, so it talks about real estate investment property, debt security, equity security, derivative instruments, unlisted instruments or unlisted securities. Okay, how to value them. uh, so to discuss that, what I'll suggest is, let's take up one question also, so that we can cover the question plus we can cover the valuation of investment also. Okay, so the question is that CAB Insurance Company Limited was incorporated on 1/7/2020. Company is mainly in the area of health insurance and planning to expand the other field of general insurance. You have been appointed as a chief financial officer of the company. The company has made investment as per the guidelines in the real estate investment property and equity securities and derivatives. Kindly guide the CFO as to how the same should be valued. This was asked in one of the exam and it was for 4 marks. So this is directly related to valuation of investment. Okay. Now, valuation of investment, how it is required to be valued. First, we'll talk about real estate investment property. Okay. So real estate investment property is required to be valued. First, it is required to be taken at the historical cost, but then a revaluation in every 3 years is required. So first, historical cost, then once in 3 years, revaluation is required. So determine at the historical cost first, and then revaluation at least once in every 3 years is required for a real estate investment property. Okay, and accordingly, if there is a change in the carrying cost of the investment property, okay, then that shall be taken to the revaluation reserve. So if there is a change in the carrying cost, you need to take to the revaluation reserve that particular change. Okay, then what you need to do is you need to determine that at the every balance sheet date whether is there is any impairment. So you need to perform impairment testing for that particular property. Okay, then the gain and loss that is arising due to change in the carrying value are required to be taken to the revaluation reserve. Both, it's not only the losses, but it's gain and losses both. So we need to take gain and loss both to the revaluation reserve. Okay, then I'm just covering the important points from these particular regulations. Even the profit on sale of investment or loss on sale of investment shall be included in accumulated changes in the carrying amount previously recognized under the revaluation reserve. Okay, So it is required to be taken to the revaluation reserve or impacted to the revaluation reserve for that particular property. Okay. Now, from disclosure point of view, the basis for the revaluation are required to be disclosed in the notes to account. So basis for the revaluation are required to be disclosed in the notes to account. Now you need to provide, okay, how the revaluation is done, what is the revaluation, and what are the what is the basis that has been adopted. Okay. So this is the additional disclosure requirement. Now, there are certain guidelines which can be issued from time to time, by the authorities with respect to the releasing amount from the revaluation reserve. Okay, amount to be released from the revaluation reserve. But again, that will depend from time to time and it's case to case basis. Unless and until there is no direction, okay, unless and until there is no direction, no amount shall be distributed from the revaluation reserve account to the shareholders. So till the time you don't have the direction from any of the authority, okay, to take out the amount from the revaluation reserve and to distribute it to the larger public or larger shareholders, no other amount shall be distributed to the shareholders out of the revaluation reserve. That is a very important thing that we need to understand. Till the time we don't have any authority's direction, we are not required to disclose. Clear? Okay. Then any impairment loss on a revalued asset, okay, the asset that we have revalued, okay, shall be treated as an like shall be treated as to the revaluation reserve. It shall be taken to the revaluation reserve. Now, when there is an excess compared to the revaluation reserve. Now, if you have there is a loss, but this exceeds the revaluation reserve. Okay. Now the impairment loss exceeds the revaluation reserve, the balance which is there in your liability side, the impairment loss exceeds that. Then in that case, the excess amount shall be taken to the P&L account. So let's say, for example, your impairment loss is rupees 100. Okay. Now you have a revaluation reserve of rupees 50, or let's say of rupees 70. So 70 will be adjusted against here, but rest of the 30 will be, this is an excess, will be taken to P&L. So that is the requirement, that excess of, okay, impairment loss which exceeds the revaluation reserve shall be recognized as an expense in the P&L account. Clear with the valuation of real estate investment property? Okay, so there is one doubt with respect to the AS3 and AS17. Okay, no issue. See, AS3 and AS17. What is AS3 said that indirect way, prepare your finding your cash flow through indirect way. But here, AS3 is applicable with respect to the direct method, not the indirect method. So that is the one change. And in AS17, as per the accounting standard applicability, there are certain categories, and in certain categories, AS17 is not applicable. But here it is applicable irrespective of the turnover requirement or listing requirement. AS17 is required to be is applicable irrespective of those requirements. So you can say AS17 is mandatorily applicable to all insurers. So that is a change compared to the normal accounting standards applicability in this particular case. I hope I'm clear. Rest all are same. Rest all accounting standards will be applicable as they are. So there will be no change in that. Any doubt, guys? Any doubt with respect to the valuation of real estate properties, real estate investment properties? This was the question which was asked for the 4 marks. See, this is very important, and I told you from where it is coming, what is the base we are discussing over here. Okay, so very, very important to understand this. Any doubt, guys? Okay. The second investment can be debt securities. Okay. So let us see the debt securities and how they are valued. So real estate property, we saw that is there. This is covered in question. Now, second one is debt securities. So how to value debt securities? Debt securities are valued, are considered as held to maturity if they are considered to be held to maturity. Okay. Now, if they are considered to be held to maturity, then what we need to do is we need to measure them at the historical cost. So they are measured at the historical cost. Now, debt securities will include this will include government securities, okay, then redeemable preference shares, okay. So redeemable preference shares, debt securities, or government securities will form part of debt securities only. So debt securities held to maturity will be classified as a held to maturity, and then you need to measure them at the historical cost subject to the amortization. Pretty simple. The third area is equity securities and derivative instruments that are traded in the market. Okay. Now, again, I'll go back to the question because that is covered over there. So, valuation of equity securities, derivative instruments that are traded in the market. Now, these securities, that they're the listed equity securities or derivative instruments that are traded in the market, means they are actively traded in the market, are required to be valued at fair value on the balance sheet date. So fair value on balance sheet date is required for these things. Okay. Now, how to calculate the fair value? Fair value is required to be calculated lowest of the last quoted closing price on the stock exchange. Okay. So fair value is required to be calculated basis of the last quoted closing price on the stock exchange. So that is the fair value that we are required to calculate. Now, there are additional things which we need to consider for the fair valuation. Okay. We need to assess the impairment of the listed security on the balance sheet date. So we need to check for the impairment, whether any impairment is of listed security is there on each balance sheet date. Okay. Then we need to check whether the active market active market is there. So when I talk about valuation, I'm talking about active market. So instruments that are traded in the active market. So we need to see that, there should be an active market also. Then the unrealized gain and losses which are arising due to change in the fair value. Let's say fair value earlier was 100, now it becomes 120. Now what we should do with these fair values? Now the unrealized gain and loss arising from that fair value is required to be taken under the head of fair value change account. That is part of your equity. Okay, so it is required to be taken under fair value change account, the unrealized gain and loss. Okay, that is part of your equity. Now let me show you that particular change account. So this becomes your part of your equity. Okay, fair value change account, and accordingly it is disclosed in what you can say uh, under the equity. If you see over here, this is fair value change account. Okay, so it takes you to schedule 16. Now schedule 16 is for the investments. So sorry, schedule 16 is like, for it's for the notes of account. So it says that how it is being calculated. However, if you see the schedule for investment, okay, schedule for investment over there, I'll show you the fair value change has been adjusted. See, now this is approved investments, which is into the shares, and you will see fair value change increase and decrease. For mutual funds, fair value change increase and decrease. For 81 bonds, fair value change. So over here, you will see the fair value change, which are, increase and decrease in the investments or equity, securities, derivatives, and then it goes to the next impact goes to the sources of fund under the head equities. And if you go to a particular, if you go to that particular section, or if you go to the particular note schedule of equities, you will find a fair value change account, which will be a total of, all this particular investment, all this particular adjustment passed. Let me show you that also. See, this is part of my that particular schedule equity, and under that there is a reserve. Over that you can see fair value change account, the amount has been given. Okay, and they also provide the fair value change account represent the unrealized gain and loss on the balance sheet date on equity, mutual fund, 81 investment. Such mark to market treatment of equity, mutual fund, and 81 securities mark to market treatment as on the reporting date in line with the requirements of financial statement, auditor's report of the company, preparation of financial statement, auditor report of the company of insurance company, regulation 2002 that we are discussing, which require such investment to be reflected at the current fair value in the balance sheet date, and mark to market adjustment being reflected under the fair value change account on the liability side of the balance sheet. Okay, so this is in line with the regulations which we are discussing. So unrealized gain and losses to be taken to the fair value. Okay. Now, when you sell on this particular security, okay, now what happens? In that case, let's say there is a profit or loss. That profit or loss on the sale of that particular investment or security is required, okay, to be adjusted against this fair value change account. Okay, like we have already recognized some profit and loss in the fair value change account. Okay. Now that change is required to be, adjusted for the fair value change account first. Okay. Then, with respect to the amount that is there in the fair value change account, now, uh, except there is a prescription or an order by an authority, no amount shall be distributed from this particular fair value change account to any of the shareholders. Okay. Now, debit balance in the fair value change account shall be reduced from the profit before declaring dividends. So, if there is a debit balance, means you have a loss in the fair value change account, unrealized loss. That unrealized loss shall be reduced from the free reserves of the profit while declaring the dividend. But if you have a credit balance, then credit balance is not required to be distributed to the shareholders. Okay. Any doubt till now? Any doubt with respect to the valuation of equity securities, derivative instruments? Any doubt? This is a question which was asked also, so very important, guys, to understand. Any doubt? Okay. The third area is unlisted securities other than actively traded equity shares and derivative instruments. Now, in case of unlisted securities, they are required to be measured as the historical cost. They are required to be measured at the historical cost. Okay. Now, however, a provision is required to be created if there is a diminution in the value of the such securities. So provision is required to be created, and that provision is required to be created based on the evidence or external evidence that shows. But the reversal again is only to be created when there is an external evidence showing an increase in the value of its investment. Okay. In any of the cases, the increase shall not exceed your historical cost. So the increased carrying amount shall not exceed your historical cost for that particular investment. Okay. So that is for the unlisted. Unlisted, first you measure at the historical cost. Then check for diminution or decrease in value. Then if increase supported by external evidence, okay, then you increase but not exceeding your carrying value. Okay. So you increase the amount but not exceeding the historical cost, sorry, not carrying value, but the historical cost. Clear? That was one of the question which was asked in exam. Okay. So different type of valuation for different type of investments. Any doubt, guys? Any doubt? Okay. If no further doubts, what I suggest is let's take a quick 10-minute break. Okay. And then after the break, we can gather back and we can continue the session with respective other areas of, for the accounting side, which are the additional requirements. Okay. So let's take a quick 10-minute break. Hello everyone, welcome back. So let's carry forward. Uh, I have one question with respect to profit and loss in case of listed securities. See, in profit and loss in case of listed securities, remember we discussed that whatever profit and loss on sale of investment is there, we need to take it first to the fair value change account and then accordingly to the revenue or profit or loss account. Okay. So first we need to adjust to the fair value account because unrealized is lying over there, and then to the revenue account. Any other doubt, guys? Any doubt? Any other doubt? Okay. If no further doubts, then let me take forward to the next topic. Now, the next is the loans. Okay. Loans, how they are required to be accounted? Loans are required to be accounted at the historical cost. Okay. So loans are required to be measured at historical cost. Okay. Are required to be measured at the historical cost subject to the impairment provisions. Okay. Now, we need to understand that impairment provisions, like on the particular loan shall not be lower than the the guidelines which are there from the RBI or from the MCA with respect to the provisions. Okay. So how we need to do impairment is the same that we do in the case of company. So there is no difference in that. Okay. Then linked business, ULIP business basically. Okay. So the valuation of investment that are required to be used, okay, or accounting principles that are required to be used for the valuation of linked businesses. It's it's same that we are required to use for the valuation of investment. So it's the same principle that we used in investment will be used here. So same as investment. Okay. Now, that was with respect to the valuation and measurement on the some areas. Then I would like to discuss on some areas like with respect to the what you can say as an auditor's responsibility with respect to certain areas. Okay, like how we are required to audit certain areas and how we are required, what is our role basically in those areas. Okay, so let's say for example, actuarial valuation, actuarial process. Now, what is the role of auditor in that? Okay, in case of actuarial valuation. So what is the role of auditor? Let's say for example, in underwriting. What is the role of auditor in reinsurance? So all these things we need to understand, like to understand what and how we can audit a particular, area. Okay. So you can say we are discussing about the roles and roles of auditor. Roles of auditor with respect to certain areas. Okay. Now this is for the life insurance first. I'm talking about. Okay. First, I'll talk about the actuarial process. Now, what is the role of auditor in case of actuarial process? See, now in case of actuarial process, actuaries basically value the life insurance policies and the liabilities from that particular policy. We saw some of the returns, the compliance, and the valuation method that was given. Now, what is the role of auditor? As a role of auditor, I am required to certify whether the actuarial valuations of liability is duly certified by appointed actuary. Remember, we were discussing in case of life insurance business. Just let me show you here. In case of life insurance business, the valuation that we certify as a value, along with the actuarial value, whether the liability, the actual valuation is performed by the actuaries or not, actuary or not. So that is the we are required as an auditor to report on that. That is like I showed you for the certificate from the statutory auditor that liabilities of the insurance which have been determined in the manner prescribed. This is for the general insurance business. Same is for the life insurance business, that we are required to report whether the liabilities have been valued by the appointed actuary or not. Okay, so our role is first to ensure that the liabilities are valued or valuation is accordance with the as per the regulations, norms, okay, issued by the authority, and it is certified by appointed actuary. Okay, so we need to ensure that we need to certify basically that liabilities are valued as per the regulation and norms, and it is certified by the appointed actuary. So we issue a certificate here, and we provide that we certify that okay, yes, actuary was appointed and he has valued the liabilities as he is required to value as per the policies, norms, and all the regulations that has been issued in this regard. Okay, so that is the role of auditor with respect to the actuarial process. Number two, with respect to the actuarial process, the another role is the disclosure. Now, remember I told you that we are required to, management is required to disclose the assumptions and the methodology that has been used in actuarial process. Okay. Now, if that assumption or methodology is whether appropriately disclosed or has not been disclosed, is requires any further disclosure. So, so our responsibility is to ensure that the appropriate disclosures are made with respect to the actuarial valuation. As per regulation for actuarial valuation. Okay. Now, second area that I want to cover and I want to discuss the role of the auditor is reinsurance. Very important area that I want to cover. Reason because under the reinsurance, basically we need to understand what is the role of auditor. Okay, and before that, I'll provide you some details with the reinsurance. Now, reinsurance is something, most of you can say, insurers use as a tool to reduce their exposure. Okay, so what they do is their risk is underwritten by another insurer, or they transfer the risk to another insurer. Okay, uh, in case of the reinsurance, now it's an effective tool to mitigate or to reduce the exposure. However, having said that, there are certain additional requirements. There are certain things that we need to take care in case of reinsurance, because it's a tool, but if it is not used effectively and it is not used appropriately, then it will create a problem. Okay, and as an auditor, it's our responsibility with respect to these areas. Okay. So, in case of reinsurance, what we need to do, okay, as an auditor, when we are auditing a reinsurance, we need to check whether the, first of all, reinsurance premium calculation and payment is according as per the agreement. So in reinsurance, you have an agreement for managing your exposure. Now what will happen is, there will, in agreement, there will be premium and payment provided with, okay, how will be the premium calculated and what will be the payment that we will be making in that case. So premium and payment, okay, is as per the you can say agreement, or with the reinsurer, or with the another insurer. So is whether it is with as per the agreement with reinsurer. Okay, so that is first we need to check. Second, we need to go through the agreements. Okay, when that agreement was initiated, whether that agreement has been updated from time to time. Okay, whether the payments that are made are as per the agreement, or whether they are in the excess of the agreement. What is the requirement for that particular what you can say agreement with respect to the payment and calculation. So all these things we need to go in detail, and we need to understand, okay, whether they are appropriately disclosed or not. Okay, so that was one with respect to the reinsurance. So verification of agreements. Just a minute. I think you guys might not be able to see the writing. Just give me a minute. I think there is some issue with the writing. Just give me a minute. Okay. Now I think it's visible. Okay, good. So yeah, so verification of agreement is the first area, and with respect to the payment terms and conditions and calculation of premium is the second area. Yep. So this is with respect to the reinsurance. Now there are certain doubts. Okay. The first is Whether this is covered in the regulations, yes. See, not directly covered in the regulations. There are multiple regulations. Now there is a regulation for the reinsurance, different regulations for the reinsurance. Now in that case, this is, you can say, cumulative or roles and responsibilities coming out of all the regulations. It's not only one, it's multiple. So again, it is covering from the multiple regulations. Okay. Then any doubt with respect to the reinsurance? Any doubt? Okay. The third area that I want to cover is policy lapse and revival. A very important area, I'll say. Policy lapse and revival. Okay. Now, again, I'll cover this with a question because that was also asked in previous exams, a very important one. So you have been appointed as an auditor of the Save Life Insurance Company Limited. During the period, during the course of audit, you came across several cases of left policies. Okay. Management from the agents and life insurance, life assured, policy lapses and revival. The policy lapsation is a tracked over PMS software. You are also requested by the management to explain the clear terms about the policy lapses and revival. Also state your role as an auditor in verifying the same. So there was an issue with respect to the policy lapse. Agent were complaining about that. So management wants to understand what are the provisions with respect to the policy lapse. Okay. And what is the role of auditor in this regard? Okay. Now, what do you mean by lapse? Lapse is a discontinuation of the policy. Means the policy will not going to be, continued further because you are not paid your premium. Okay, because of non-payment of your premium dues. Now the term lapse is generally not defined here. Okay, except where it's indirectly mentioned in section 1132 of the Insurance Act. Section 1132 of the Insurance Act talks about, what you can say, that policy which has acquired a surrender value shall be kept alive to the extent of the paid up sum assured. So it is indirect way, it is said that, okay, which policy to be kept alive. Okay, and what will be its value. Now, in order to keep a life insurance policy in force, okay, we are required to pay premium from time to time, that is there. And over the time, for the payment of the premium, we are also given some grace days, like 15 days or 30 days to make the payment from the due date. Okay, now this is known as a grace period. If we do not pay in that particular grace period, the policy gets lapsed. Okay, now it's necessary to keep the policy in force. We need to pay within the due date or by the grace period. Now, what happens when the policy lapses? Okay, in case once a policy becomes lapsed, okay, a policy is lapsed, the insuree or the person who was insured in that particular policy will not get any premium or will not get any benefit of the insurance or the insurance protection. So the insured will lose its protection. Okay, and all the amount that has been paid as a premium under the policy will be forfeited. Okay. That's why even the agents do not get a policy renewal premium in case of the lapsed policy. So that's a very critical area because it is impacting your stakeholders, that's insured. It is impacting your agents because they will not get their what you can say renewal premium, so they also get impacted. Okay, and all the lapse policies are tracked over PMS software, where the due dates are monitored, and once the policy is initiated or policy is issued in the market, the due date is installed in the PMS or due date is feeded in the PMS system, and then it's continuously monitored when it is going to be lapsed or whether the payment has been done on time or not. Now, as an auditor, what is our responsibility? As an auditor, our responsibility is to check and confirm whether the due dates are recorded and monitored properly. Reason because it's everything dependent upon the due dates. Okay, so due dates are recorded and monitored properly, and policies which are marked as a lapsed policy because of the non-renewal of the premium within the due dates. Okay, so there should be appropriate marking on the policy as a marked as a lapsed or non-receipt of renewal premium. So you check the due dates, you mark them as a lapsed once you do not receive the premium within the date within the prescribed due dates or the grace period. Okay, in case you get a request for the revival, okay, in case you get a request for the revival or the insurer gets the request for the revival, in that case what is required to be seen is appropriate documents are there, outstanding amount that was required to be paid has been paid, so receipt of the outstanding amount you need to check. You need to check the documentation, adequate documents has been received before reviving the policy. So policy can be revived, but pay the previous dues and provide all the necessary documents. Then only the policy will be able to be, they will be able to revive the policy. So that is the with respect to roles and responsibility of revival, policy lapse and revival. Any doubt? Any doubts? Okay. So there is one doubt with respect to the ULIP. Okay. Now ULIP are generally unit linked insurance protection plans, wherein the plans are basically linked with what you can say with the protection. The plans are there, so they are the linked ones compared to the rest of the plans. Okay, so what happens is in case of ULIP, they are their policy or the value of the particular policy is linked to a particular investment. Now as and when the investment changes, now that is there means in investment there is not that much fluctuation, but there is a fluctuation. But with the change in the investment, the policy value also changes and the production in the policy also changes. So you can say when I talk about ULIP, unit linked insurance plan, the protection or the insurance is linked to a particular unit of investment. That's why they are known as a ULIP. I hope I'm clear. A very good question, that how samples will be selected for the lapsed policy. See, as I said, all the lapsed policies are required to be tracked in the PMS, or all the policies are required to be tracked in the PMS. So in PMS, there is a functionality available to take out the report for the lapsed policies. From there, you can take the samples, and with the help of due date, you can perform the recalculation whether these policies are lapsed or not. So you have the detail like what is the due date, payment date, payment made date, and accordingly you can say okay whether payment has been received or not. Okay, and whether this is lapsed or not. Any further doubt, guys? Okay. Now, the next area that I want to discuss, or the next area where the role of auditor is there, okay, is with respect to the premium. Now, premium are the major part for an as a revenue for the insurance business. Now, I want to discuss with respect to the premium that, okay, what is the role of auditor with respect to the premium and outstanding premium, agent balances, outstanding accounts. So I'll be discussing one by one each. Okay. So let us see with related to the premium. Okay. So in case of a premium, as I said earlier also, premium is just, like the particular amount that we collect from the insured for providing the protection. Okay. When a new policy is issued, okay, in case of a new policy, the premium is recognized based on the premium realized. So in case of a new policy, okay, the premium is to be recognized on realization. On realization of premium means it should not be recognized when the policy is issued. Generally, policy is issued after the payment of premium, but it should be recognized when the premium is received. Okay. So policy is only underwritten after the premium received. Before that, you cannot issue a policy. Okay. Second, renewal income. Okay. When the renewal income or renewal premium is required to be recognized. Now, renewal income is recognized on realization of premium or on the premium becoming due but not received up to the grace period, end of the grace period. So premium can be recognized either on the realization or when the premium is becoming due but not received till the end of the grace period. So when becomes due? Oh, sorry, on realization. Or coming due, okay, but not received up to the end of grace period. Then only I can, in these cases, I can recognize the premium, or as per these provisions, I can recognize the premium. Okay. Generally, with respect to the premium, premiums are required to be collected and credited to the separate bank account. Daily reconciliations are required to be performed with respect to the premiums collected and deposited in the bank account. Appropriate mechanisms are required to be kept in place, and as an auditor, we are required to check all these areas, the reconciliation, the credit of premium into the separate bank account, appropriate mechanism is there or internal controls are there on those particular areas with respect to, let's say, for example, calculation of premium, whether premium is calculated appropriately, whether premium is recognized appropriately on issued policies. So our role is not only to see the provision, but to the internal controls, the processes, the details, the processes that are there around these areas. The SOP is there, whether the standard operating procedures are there, the process is appropriately defined and is mature, is there any issue in the process or something like that. So all those areas we are required to look into. Okay, any doubt till now with respect to premiums? Renewal, so there is a question, can insurance company recognize renewal premium on accrual basis? See, accrual basis means you can recognize on becoming due, but if it is not received till the end of the grace period, otherwise you cannot. Okay, so if it is not received till the end of the grace period, means grace period had not passed, on becoming due, yes, you can recognize. Any other doubt, guys? Any other doubt? See, again, it's not the earlier, but in case of premium, premium can be recognized when it becomes due. But when I talk about this grace period concept, okay, in grace period, so in grace period, what is happening? We are giving additional period to pay them. Okay, we are not. It's till the grace period. It is not becoming due because we have given 2 days, 3 days, 15 days, 30 days grace period to pay them. Okay, so once it becomes due, then only we can recognize the premium in our books of accounts or upon realization, whichever is earlier, correctly. Yeah. But it is not something grace period or due. There is no earlier between them. Okay, so that was with respect to the premiums. Okay, now the next area I want to discuss. So these were certain areas where where we discuss the auditor's responsibility. There are other areas also, because auditor's responsibility is not only restricted to the premium, but each and every area of the financial statement. So if I say it's only related to this, answer is no. There are each each line item in the financial statement owes a responsibility to the auditor. Now let us see some of the questions on these roles of the auditor with respect to certain areas. Okay, you've been appointed to carry out the audit of Blue Insurance Company Limited for the year 1920. In the course of audit, you observed that the commission paid to agent constituted a major expense in operating expense of the company. Enumerate the audit concerns that address the assertion required for the auditor to ensure continued existence of the internal control as well as financial fairness in the amounts in accounting to the commission paid to the agents. Okay, so one is commission paid to the agent. That's a very important area, because again, that's a major expense that is that's part of the insurance business. It's a very major expense. Okay, now if you talk about the commission, basically commission, as I said, it's a very major expense. and it's paid for, as a direct business, as a direct what you can say expense. Now in case of insurance, generally all the policies are, all the customers, or uh, our clients in insurance are through our agents. Okay, so agents get commission on the renewal, on the start of the policy. If the new policy is issued, agents get the commission on the renewal of the policy. Okay, on commission on reinsurance accepted. So there are a lot of many, commission, different types of commissions that are paid to agents, and that is calculated based on a percentage that is applied to the premium collected. Okay, that is based on the percentage which is then, applied to the premium collected. Now when I talk about commission, like which is required to be paid, what is our role as an auditor with respect to the commission and brokerage that is required to be paid to the agent? Okay, so our role is, first of all, we need to ensure that there is an appropriate system. Okay, there should be an appropriate system with respect to, calculation of the commission that is required to be paid to the, agent. So how the commission is calculated behind each and every policy? What is the percentage on which, which is calculated by multiplying to the premium to calculate the commission? So whether these percentages are approved or not. So first of all, we need to understand the system. Behind the commission calculation. Then we need to see the payment system. Now, okay, we identified this is the commission calculation. Okay, this is how the commission is calculated. And based on this, based on calculation, based on calculation, commission will be recognized, okay, in books of account. Now, once it becomes, once we book a liability for the payment of commission, we recognize an expense. Okay, then we need to understand what is the payment system of the commission. So payment system of commission. Now, why we need to check the payment system? See, in case of renewal of policies, when is the commission paid to the agent? Is it at the time when we collect the renewal premium, or at the time before the collection of renewal premium, or how much after the collection of renewal premium the commission is paid to this particular agent? Even in case of the new policies, okay, what is the percentage, when it is paid, how it is paid? Okay, everything is required to be looked into, because these are the critical areas. Then whether commission paid is within limits prescribed by the authority or prescribed by the act, regulations, rules, etc. Okay, so the commission paid is within the limits prescribed by the act, regulation, rules, etc. So there is a limit prescribed, and we need to check whether the limit it's within the limit or not. Okay, then for the outstanding balances, okay, now here we need to understand for the outstanding balances, what we need to do is we need to check whether the commission that is not paid. So what is the particular due date for that? Like, how much age it is. So aging of the outstanding balances. Okay, of commission still to be paid or not paid. And why this is required to be checked is because in certain cases, there is a commission clawback or commission cancelled because policy got cancelled. So in those cases, what happens is the commission either is kept on hold or is deducted from the commission that is required to be paid. So we need to understand whatever outstanding balance of commission is there, which is not paid, whether any clawback is pending or adjustment is pending. So we need to understand whether any adjustment is pending. That's why you are kept outstanding, or what is the reason of keeping it outstanding. Okay. Then another area we need to check with respect to the commission is with respect to the agent. So we need to check whether that particular agent is blacklisted by authority or company to act as an agent. Okay, we need to understand whether he has been blacklisted to act as an agent by authority or a company. If yes, then we cannot pay him the commission. Even we cannot, transact with him and take, allow him to, issue, like be an agent of our be an agent of the insurer. So we need to check in that way. So these are the areas we need to, look after from the commission side. Clawback means taking back. Let's say, for example, you issued the commission to an agent, but suddenly after 30 days, a person comes, of a issue of a new policy that he wants to cancel the policy. So in that case, the insurance companies, they have some of the target. Okay, the insurance policy must survive these many days or something like that. That should not be cancelled within these days, otherwise the commission will be taken back. So in case for the cancel policies, the commissions are taken back. That's the clawback. Any doubt? Any doubts till now? Okay. Now, the next area I want to discuss with respect to the reporting side. Okay. Now, there is a management report, okay, which is required to be attached to the financial statement. As per the regulations, okay, there is a management report that is required to be attached. So I will be discussing the content of that management report, what are the things that are required to be part of that management report, and then show you the management report in actual how it is done. Okay. So the management report is required to be, as per the part 4 of the regulation. The regulations I was discussing about preparation and presentation of financial statement and auditors report. So that management report, just a minute. is required to be as per part 4 of the regulations. Okay. Now there are certain details, or there are certain prescribed items in that management report that are required to be included, or that should be part of the management report. Simultaneously, I will discuss the one of the live management report that is there available, so that you can have an idea how the management report is actually made, and what are the contents of the management report, which are there. Okay, so management report. Now this is something, this management report is made, like issued by management itself, and it should contain the following items. One, confirmation regarding the continued validity of the registration. Okay, so confirmation I'm not sure why it's not working. Confirmation regarding continued validity. Okay, so that the insurer is having the certificate of registration and it is valid. Continued validity of registration. That is the first area that is required to be part of my management report. The second area is that dues payable to the statutory authorities have been paid. Dues payable to statutory authority has been paid. Okay. Then the next area is that the shareholding pattern or any transfer of the shares during the year are according with the provisions of or requirements issued by the authority. So shareholding pattern and transfer of shares are as per regulations. Okay. Then declaration that the management has not directly or indirectly invested outside India the funds of the policy holder. Okay, that the policy holders funds are not invested outside India. Then confirmation that the solvency margins are maintained. Okay. Now, then a certification that the values of all the assets has been reviewed on the balance sheet date. Okay, and their values, aggregate amount that are reflected in the balance sheet, they do not exceed, their realizable value or the market value. Means they are not overstated, in other words. So all the assets are appropriately valued and not overstated. Then the next area is that the funds of the life insurance, okay, that the funds of the life insurance are not applied to any of the, what you can say, area which is prohibited, or you can say that that no part of the life insurance funds are applied in the contravention to the provisions that are there for the application of investment. So investment are applied as per the provision, and there is no contravention for the application. Then there is a disclosure required for the overall risk exposure. Disclosure for overall risk exposure. Okay. Then a certification, then if entity is operating in other countries also, okay, then other countries risk and exposure is also required to be given. So if entity is operating in other countries, then risk and exposure of that particular country. Now let me show you, till this point, there are other points also, then agings of claims, certification, I'll also show you, but let me show you first the management report, so that whatever we have discussed till now, you can have a clarity on that. Okay. See, this is the management report. Okay. Now, first, certificate of registration and continue to hold certificate of registration. That was the first point. Okay. That the company has paid to IRDA annual fees and as amended the registration certificate granted by everything. Okay. Second, statutory liabilities, that we have paid the statutory liabilities except those under dispute. Shareholding pattern, that no shareholder has been transferred during the year, or means the shareholding pattern is accordance with the statutory requirements. Then this is a shareholding pattern. Investment outside India, the management has not invested any funds of policyholder indirectly or directly outside India. Okay. Then the next point is a solvency margin. Now for solvency margin, remember we need to disclose, okay, the solvency margin has been complied throughout the year. So see, the actual solvency margin ratio 344% and required solvency margin ratio 150% last year also. So that is the actual versus required. Then valuation of assets in balance sheet, the 6 point, that the value of the asset in the balance sheet is appropriate, and it's not exceeding any of the market value or realizable value. So see, value as per the balance sheet or book value of the debt investment, market value of the debt investment. Now why only debt investment? Because rest of the assets are normally valued like as per the cost only. Then overall risk exposure. So what is the risk exposure the company is having? See the detail on the risk exposure and the strategy adopted to mitigate it. So they provide the detail, what is the risk exposure and what is the strategy they have adopted. So they have dedicated independent risk management committee, executive risk committee. So these are the committees which are continuously monitoring the risk. So there's a lot of detail that is given for the risk management area. Okay. Then operations outside India. So if they have operations outside India, then they are required to disclose for that. But in this case, company does not have any operation outside any country or any other country other than India. So again, now, so in that case, this is the particular that is given. Okay. The next area is with respect to the aging of claims, indicating the trend in claim settlement during preceding 5 years. So we need to provide trend, okay, with respect to the settlements. But here they have provided the detail with respect to so with respect to some COVID related things, and because in COVID there was a huge claim and settlement of the claim, and this is the health insurance business. So they have mentioned that tend to have a longer settlement times which are beyond the control of the company. During large parts of FY22, the spurt in health insurance claims on account of COVID-19 treatment continued on account of sequential waves of multiple variants. So they are facing issues with respect to the claims related because of the COVID claims and everything. So they have mentioned that. Then the next area is review of asset quality and performance in investment in terms of portfolio. Okay. Now the management is required to provide the valuation of investment and review of asset quality. So first, the value of investment. So as I said, each and every investment is required to be valued accordingly. So they will say, okay, debt securities, non-convertible preferential shares. So these will be, including government securities and non-convertible preference shares are considered held to maturity, accordingly stated at the historical cost. Additional tier 1 perpetual bonds, they are again, they are part of equity and valued on market valuation basis. Money market instruments valued at historical cost and adjusted for amortization. Equity shares, again, last quoted closing price on BSE Limited. Mutual funds based on their NAV. And fair value accounting, fair value change account, it's based on the adjustment that is passed. Then they are required to disclose the review of asset quality and performance of investment. So in case of asset quality, so they provide the composition first of all. What is the asset composition? Okay, based on the total investment is there. Let's say, for example, how much into the government securities, how much is which rated, debenture minus AAA, minus AA or A double plus, below minus AA. So accordingly, every detail is given. Okay, which investment is in which, and they provide that particular detail. Okay. Then again, they provide the details with respect to the fixed income portfolio from the investment, what is the rating of the investment and everything. Now, when it comes to asset performance, okay, so there is a calculation and there is a detail that they provide with respect to the asset performance. So with respect to the asset performance, see, including impairment, excluding impairment, book value, which was there, book value yields and market value yields. So they calculate the performance and they provide this particular performance over here. Okay. The next area that is required is the payments that are made to the directors. So payment to the parties which directors are interested. And the last area is certification by the management. Okay. So management is required to certify certain areas. So it says that the management of the company certifies that the financial statement has been prepared of the company in accordance with the applicable accounting standards. Management has adopted accounting policies and applied them consistently. Management has taken proper and sufficient care for the maintenance of adequate accounting records. Okay. Financial statement has been prepared on the going concern basis, and the management had set up internal audit system commensurating with the size and nature of the business. The same was operational throughout the year. So this is how the management report is prepared, and these are the part, and these are the, what you can say, contents of the management report. Any doubt till now? So as per the Insurance Act, there are certain requirements with respect to the shareholding pattern. Okay. If you look into the section 6A, it says that requirement as to capital structure and voting right and maintenance of register of the beneficial owners. Then if you look into section 6B, okay, it says provision for securing compliance with the requirement relating to the capital structure. Then there are other regulations which restricts the capital structure, and because of the foreign investment, or who is the promoter and everything. So there are a lot many details in that. See here, Bajaj Finserv is an Indian company, and Allianz SC is a foreign entity, foreign group. So basically, like it is from the outside. You can say, outside India. Now remember, in the start we discussed about the holding. So we discussed over there that Indian insurance company means foreign investment less than foreign investment should be less than what you can say 25% or 74% of the equity should be there. Foreign investment should be less than. So in that case, if you see over here, it's only 26%. Rest is 74% with the Bajaj Finserv Limited. Any doubt? Any doubt? If no doubt, then I have one question. If no doubt, then I have one question. So I would like to ask, whether CARO is applicable to insurance company. Whether CARO is applicable to insurance company. You tell me whether CARO is applicable or not. Whether CARO is applicable or not. Come on, pretty easy. Okay, Shailendra, Sumit. Okay, Shailendra. Good, Kaushiki. Correct, absolutely correct. Remember when I was discussing CARO, I specifically said, if I go to the CARO applicability, BIOS 8 is an exemption. I stand for insurance company. Means Caro is not applicable to the insurance companies. So Caro will not be applicable to insurance company. Not applicable to insurance company. Now, next question. Whether audit for AB will be applicable to insurance company. Okay. If let's say assume their turnover is more than the prescribed limit. So whether audit under section 44AB will be applicable to insurance company, or whether this particular section will be applicable to insurance company. Whether section 44AB will be applicable to insurance company. Okay, good, Sumit. Very important question. Whether section 44AB will be applicable to an insurance company. Come on, guys. Pretty easy. We have already discussed this particular topic, like audit under section 44AB, fiscal audit. Whether audit will be applicable to an insurance company. Section 44AB will be applicable to an insurance company. So let's go back and check. Okay, fiscal audit. Remember rule 6G or let's say tax audit. Let's go to section 44AB. When we talked about section 44AB, over there we saw there was every person. There is no exemption with respect to the type of person. They talked then business. Again, there is no exemption of insurance business. Okay. Then there are specific section, but again, there is no mention of any insurance business or anything. So it's assumed that every business will contain insurance company also. If every business contain insurance company, then 44AB will be applicable to the insurance company also. Okay. So if the conditions are satisfied, then insurance company are required to have their accounts audited under section 44AB of the Act. Clear? Any doubt? So it is applicable. Any doubt, guys? Now, so if you see, there is a specific section under Income Tax Act, that is section 44. I'm not talking about 44 AB, it's 44, plain 44. It says that, okay, income, it says that anything which is contained to the provisions in the act related to the computation of interest from securities, income from house properties, capital gain, income from other sources, or 199 or 2843B business and profit gains. Okay. In that case, the income of the mutual insurance company, okay, or business of insurance, okay, is required to be calculated in accordance with the rules of first schedule. So in Income Tax Act, as per section 44, there is a first schedule, okay, and the that first schedule prescribes that how the income is required to be calculated in case of insurance business. Okay, so first schedule gives you insurance business detail, okay, how a profit should be calculated from the insurance business. Profit of life insurance business, computation of profit from life insurance business, again, how it is to be taken, then adjustment for the tax paid by the deduction at sources, everything. So some details are given, and that details are required to be complied when we are calculating the income for the for the insurance business. Okay, so we need to comply with section 44. With section 44 plus first schedule of Income Tax Act for computation of income. For computation of income, okay, or for computation of income for insurance business, you can say. Clear? Any doubts? Any doubt? I'll just show you if I can here. See over here. This is the first schedule, okay, of insurance business under section 44, life insurance business. And here you have a detail like, profit of life insurance business to be completed separately. Their computation of profit of life insurance business, how it is to be calculated. Adjustment by way of TDS, if any TDS is paid. For other business, again, they have given details. Okay. And what is required to be added back, that is provided over here. Okay. Then profit and gains of non-resident person and some interpretation things. It is small detail, but it is given over here. This is schedule, first schedule that I was talking about under section 44. Okay. Ind AS is not applicable to insurance business. It's AS, it is applicable. So Ind AS is still not applicable. Any doubt, guys? Any doubt with respect to any of the area? Okay. So, if no doubts, then I propose if to keep the lecture till here, and in the next lecture we will be discussing it's I think in the next lecture, just give me a second. We will be discussing audit of public sector undertakings. Okay. And after that, there will be a special audit for, like, special aspects of auditing in an automated environment. So these are the two lectures that we'll be taking in the, like one on Monday, one on Wednesday. But what I suggest is you guys is please be prepared with the topic audit of public sector undertaking. Okay. When I will be discussing, I will be expecting, you have read it once, so that, you will have additional clarity when we will be discussing over here. Okay. Or you will have questions, or you can, you will be having, some doubts, and that doubts can be cleared over here. So that will be, you can have a good clarity of the topic. Number two, please provide your feedback. It's very important for us to understand, the things that you like, the things you don't, and what additional things you need. Okay, so be ready with the topic, and I'll see you in the next lecture, guys.